Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Because understanding your wealth shouldn't be as complex as building it. Welcome to today's show. Kristof Gleich, it's lovely to talk to you today. I'm going to do a quick bio and then we're going to get into the thick of it. You are the president and CIO of Harbor Capital Advisors. You've previously been at JP Morgan in manager research and selection. And I think before that, you were at Goldman. You have a degree in physics from the University of Bristol, and you are a CFA charter holder. When I look at the common thread across your professional experience, whether it be JP Morgan in New York or now Harbor Capital in Chicago, what I note is your commitment to something that we're going to describe as the multi-manager model, i.e. partnering with specialist investment boutiques instead of kind of building everything in-house. Do you want to take me to the Situation Room and explain to me the logic?
Sure. So I began my career in the early 2000s and 2001. I started life at Goldman Sachs for my sins. And after a few years, I transferred internally to GSAM, which stands for Goldman Sachs Asset Management. And really through chance more than anything, I ended up working in a group called the GMS, the Global Manager Strategies Group. And that group was responsible for picking third-party managers outside of Goldman Sachs and doing due diligence on those managers and ultimately making recommendations to clients to build portfolios using best-in-class managers outside the four walls of GSAM. That was how I began my life in investing. It's something that I gravitated towards and something that I fell in love with. It's still something I largely do today at Harbor Capital Advisors in a different form and for a different client base. But that marriage of finding specialized, best-in-class managers, really trying to figure out what makes them tick, trying to figure out what makes them special, and investing with them, it's something that I love doing and do to this day.
So when I think about that, the term of practice is sub-advisors, right? You're finding investment boutiques outside of the four walls of the firm you operate at, previously Goldman Sachs in London, now Harbor Capital in Chicago. And you go and meet with them, you do due diligence, and eventually you say, yeah, I believe in the theme, I believe in the team, I believe in the processes, all of that. I often talk about mechanics, psychology, and purpose. But let's talk about the mechanics of due diligence. And let's just start with the yuck. When you look at a manager, what are the things you walk in that are kind of hard nosed, where if you hear something, you're like, oh yeah, not for us?
Honestly, it's very unusual that you would walk into a meeting like today. Like, the industry is so professionalized compared to like 25 years ago. In reality, it doesn't really happen. It's much more nuanced now. Some of the clear things that you look for are alignment of interests, investing in their own funds, eating their own cooking, and things like that. So if still today, in the very rare instance, you find an example where a manager isn't invested heavily in their own portfolio, that would be an immediate no. The fact is, most of the managers that we invested bet their entire career and their livelihood on what they're doing. So you very much get that natural alignment. I'll give you one that stands out from about 20 years ago. It was in Berlin, in Germany, and we were looking at investing in a renewables manager, so a manager that was investing in renewable energy. We did a bunch of due diligence calls. A lovely guy, and he said all the right things, claimed to be a long-term investor, and seemed to have an interesting process and background. And anyway, as we always do, and as I would always recommend to anybody, do your own homework in investing, trust but verify. And for us, the but verify bit means always going on site and, meet them in person and see if what you see physically squares with what you thought. And so we went for a day trip to Berlin, and this manager, every 3 or 4 minutes was leaving the meeting, taking calls on his mobile phone and giving buy and sell orders like day trading. And it was a complete red flag. And everything that he had basically told us was, BS. And I don't know if still to this day that they were trying to like show off that they could kind of trade real time while we were there. And they thought that was kind of cool, but it backfired massively. And so, an immediate red flag would be something like that, where it's just completely inconsistent with what your expectations are. And so you're just like, not for me. There's too many investors to invest in. So yeah, that's the example that stands out.
That's funny, and it's very true in most cases where people have this vision, presumably from the movies, from Wall Street or something, or The Wolf of Wall Street, where being an investor means screaming buy, sell all day long, when the more likely path to success is to do very little and let time be your ally, particularly when you claim to be a long-term investor, right?
I find it's the nuanced, look, it's a mosaic that we're trying to build. It's really hard as an outsider to understand what's happening inside the four walls of anywhere, and it can take a long time. And I think there are some tells that you can look for. If I go and visit a company or a firm that I'm thinking about investing in, then I find getting outside of the meeting room, fine, you have the meeting, you go through the whole pitch book, you ask a bunch of questions on stocks, and that process, that philosophy, and what they think, and why they've made certain decisions. But then, like, if you want to go and stretch your legs, you need to go and, use the restroom or whatever it is. You walk through the corridors, you see people sat at their desk, you have these little impromptu conversations with people. Oh, what do you do? Do you like working here? What's it like? Hey, if you had to describe the culture, what would it be and why? And you can very quickly garner from those very brief interactions, like, are people on the same page? Are they saying the right things? Are they kind of, singing from the same hymn sheet? And I think it's those little unscripted moments that can be kind of quite significant cultural tells. That is what's being presented to you. Is there depth to it, or is it just words?
Yeah, I think that's brilliant. It's the talk to the junior person, see how they're experiencing it, see how the senior person is treating the junior person, by the way, how they're treating the waitstaff if you're going to a restaurant, all of those things. Reminded, when I was getting my doctorate, I took an interview with a large hedge fund. This is late 2007, early 2008. And when you're on the job market as a post-grad, you're invited to give your job market paper. You go and you present. And I remember being invited to see these guys, and basically these guys were the biggest jerks I'd ever met. They spent an hour and a half just tearing into me. In my mind, I'm like, you're young and you're insecure, and you're like, why did you invite me to just be a jerk to me, right? It had nothing to do with me. Within 2 or 3 weeks, they literally had blown up and they were out of business. So it's just, you feel the tension. You feel like what's going on with them. And you remind yourself, this rarely has anything to do with me.
Exactly. Well said.
As I think about the world of asset management, the players on the chessboard who actually run funds and strategies and then eventually make them available to the investing public. A good friend of mine, David Noddick, has this wonderful way of describing the different players on the board. And the way he describes them is either they're white hat firms or they're black hat firms. And what he's trying to capture is when the proverbial poopy hits the fan, it always does. Something happens, whether it's operational or from an investment standpoint or whatever. Are they going to be proactive? Are they going to be investor friendly? And I think that's critical too, right? To know about the culture of ownership and responsibility in a way. Would you say that's part of your process?
Yeah, and I think that's right. I mean, the character of the investors that we are investing in is very, very important. Do they do the right thing by their clients is absolutely critical, but also that's a role that we play for our clients as well. So the way that we typically work with managers is if we find a manager from somewhere in the world in an asset class that we have high conviction in and we think is doing something different, we typically look for managers we describe as boutiques. So, the names that your listeners may be familiar with, the BlackRocks, the JP Morgans, the Vanguards, we're not really looking for those types of managers. We're looking for kind of more specialization, smaller boutiques, smaller capacity type strategies. And then we ultimately invest with them and package their return streams to everyday investors in an ETF. And in an ETF wrapper, there's all sorts of regulatory controls which we have to be responsible for to make sure our investors are getting a good experience. So the legal and compliance and operational due diligence and oversight that we do is incredibly important. The NAV calculations that we do and having all of those systems and processes in place to make sure that clients are getting what they expect is incredibly important.
Right. A NAV, a net asset value, has to be struck every day, and that's part of the equation. And you don't go home until it's done.
And it's got to be right, because if you have an NAV that's incorrect and someone buys it on that day, they are getting bad pricing and they have to ultimately be made whole. So it's a super important and less talked about aspect of our industry.
That's exactly right. And by the way, I think that's a perfect example of differentiating a white hat firm and a black hat firm. The white hat firm will say, hey, just so you know, we had the NAV wrong and let's deal with it, as opposed to you having to kind of do the discovery work, so on and so forth. So you just introduced the concept of ETF. An ETF is really just a legal construct. It's derived off of the concept of a mutual fund. And historically, the ETF format, the ETF wrapper, has been really used for, let's just call it core and bore investment strategies. Hold the S&P 500, keep it simple, keep it cheap, don't mess it up. Your firm and other firms are helping evolve that wrapper to include things like active strategies, systematic strategies, alternative strategies, often coming from, as you said, boutiques. So talk me through the evolution of alternatives inside ETFs and, how it works, where it struggles, all of that.
Yeah, so historically, Harbor have been around since the early 1980s. And we were a mutual fund company, first and foremost. Launched our first set of mutual funds in 1986. And for decades, the mutual fund vehicle was the lowest common denominator for a number of different investment types. And it worked really, really well. And then I think it was the early 1990s, ETFs came along. And ETFs were sort of synonymous with what we would describe as passive investing or index investing. I hate the phrase passive. I don't think there is any such thing. Passive investing doesn't exist. Like, all investing is active. It's just different degrees of active and what you're trying to sort of solve for. But anyway, ETFs went down the index route. And then lately, there's been a big change in the industry. And when I say lately, in about the last 5 or 6 years, what we describe as kind of active ETFs have become much more prominent. There was a regulatory change in 2019 called the SEC rule, and that really laid the legal foundation and framework to launch active ETFs. And what I mean by active there is where you're looking to derive a different investment outcome from a common benchmark or index. So if you're investing in US securities, you're probably trying to produce a different return, a better return from the S&P 500, or in fixed income, a fixed income index, or commodities, a different commodities index. And so we've really leaned into this as a firm. We now have more active ETFs than we do mutual funds, which, given that we've been doing mutual funds since 1986 and we've been doing ETFs for about 4 years now, it's quite an extraordinary change. And the reason why this is happening is, look, ETFs, you described it as a legal construct. Like, yes, it is. It's a better legal construct. Why? They're more tax efficient, they're more transparent, and they're lower fee. The definition of alpha is doing what you do today, but doing it tomorrow for cheaper, right? And if you can do it for cheaper and you can do it from a better sort of tax and more tax advantageous perspective, more tax efficiency, that's why they've really grown. And that's why we've really leaned into them. And so we try and find areas of the market that we think active can add alpha. By alpha, I mean generally performance over and above a publicly stated benchmark. But the definition of alpha for us includes a more nuanced expression of skill instead of just luck. And so we're really trying to look for skill-based approaches to adding sustainable returns that you can get above kind of common passive investing.
Yeah, and just to clarify the mechanics behind why ETFs are more quote unquote tax efficient. It's not a law of physics, let's be clear. And I always worry when we use kind of present tense in their proper application that allow for more tax efficiency, because there is a weird thing that is part of the mechanics of an ETF called a creation and redemption process that allows you to move assets in and out of an ETF in a way that is not possible in a mutual fund construct. And the way to think about tax efficiency, or certainly the tax burden of a fund, is generally speaking, any tax event that happens inside the box, inside the legal construct of the fund, the investor owns that tax event. When the tax event happens outside the box, then it's more tax efficient. But if you do a bunch of dumb tax inefficient things inside an ETF, congratulations, it's not tax efficient.
Thank you there's for sure no laws of physics at play here. It gives the issuer the ability to thoughtfully make the journey for the investor more tax efficient by using things like the create and redemption process, these custom creates, these custom redeems. But you have to have skills, the infrastructure, the knowledge to benefit from those advantages. Yes, you do definitely need to do your homework, because if you look at some ETFs out there, actually they do produce taxable gains when they don't need to.
So you started your life, let's just call it more on the institutional side of things at, GSAN and so on and so forth. You also made a journey physically from the UK to the US, New York, and now Chicago. But let's talk about your journey from the institutional space to now a space that is more wealth management driven. Tell me more about how you translate that knowledge base, that skill set from institutional portfolios to taxable accounts, so on and so forth.
Yeah, so I think the worlds are converging rather than diverging. Now, look, we don't service the very retail end. We don't have a direct to retail business. So we're not selling to the end individual retail investor. Our clients tend to be financial intermediaries. By that, I mean these regional banks, broker dealers. And I think the gap between the most sophisticated portfolios in the world and investment advisors is closing. And I think there are far more similarities now than there are differences, which I think has been a really interesting change over the last 20 years. Just generally, people are a lot more aware. They're a lot more sophisticated. Technology has enabled, commoditization, if you like, of knowledge. If I think back 15 years ago, what would have been a really differentiated 15 years ago was to say, hey, if we're talking to an institutional investor and you're like, look, here is a approach to money management that is a value approach to management. You can do this thing called kind of factor regression, and you can look at how much of the returns from this approach are coming from factors versus how much are coming from skill and what we describe as idiosyncratic. That conversation like 15 years ago was very specialized, and the addressable market of people you could have that kind of conversation with was very, very small. Like it was Geek Town that you would have those types of conversations.
Still Geek Town, Kristof, you and I are talking. We're in good company here.
Yeah, you're probably still right. But anyway, I think that way of thinking has become much more widespread, that the knowledge has spread. And now you can go and talk to an RIA and talk about different factor loadings and what's behind alpha and how this works. And so the level of sophistication has gone up much more. Like the old days of 15, 20 years ago of going out on a golf course and playing golf with advisors, and that was the way that you won business. Thankfully, it's completely different today, and it's much more professional. It's much more sophisticated.
I think that's right. I agree with you. The geekiness has reached a broader audience. I did something that was not dissimilar to kind of what you did in the early days in terms of talking to hedge fund managers and understanding their performance when I worked for the Ziff family. And I will just say, I think there was a time when people talked about alpha, and they actually were misusing the term. They looked at like their return stream, they subtracted the S&P, and they were like, here's my alpha. Yeah. And then the first round of conversation was like, whoa, what happens to like how much of your return is the market, right? So all of a sudden you're not subtracting the S&P, you're subtracting the S&P times a thing called beta. And I was like, you blew people's mind, because if you actually, and then pretty quickly we were talking about compensating people on the basis of net of factor exposures, right? So you're saying, well, if all you do is buy a bunch of mid caps, I'm not paying for that. So I agree. I think the sophistication, hopefully, if we're lucky, the sophistication has broadened and is making people just better stewards of funds. Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode.
It also means that you're paying the right level of fees for the right level of service that's being provided as well. I'm sure any portfolio manager would talk about their overall return as being their alpha. And then you deducted the market. We're getting more and more sophisticated with what we're taking away and really what we're left with at the end of the day, which is a much, much smaller slither, which is genuine alpha. That's the piece that's worth paying for if you can find it, let alone if you can generate it.
Again, as I said to you earlier, I often talk about mechanics, psychology, purpose. Let's apply those concepts quickly to the space that you inhabit. When you think about mechanics outside of the core and bore stuff, outside of the S&P and the ag and so on and so forth, how do you think about mechanically managing that for a portfolio in terms of exposures, sizing, liquidity, tax implications, all of that? What are the mechanical vectors that people have to pay attention to?
So for us, I suppose the mechanical vectors are whether something is discretionary or whether something is systematic. And I think those are probably the two vectors that are the most important. So if something is systematic, you have to look at its edge in a different way. If something is systematic, its edge that's going to generate its alpha is going to be driven more by data, whether it has a unique data source that is hard to replicate, how it's marrying those different kind of factors together. Whereas if you're looking at something that is more discretionary, and by discretion, I mean a human being has discretion, honing in on the edge there and really understanding what the edge is. And typically that can sort of fall into like an interpretational edge or a research edge that the manager has in generating alpha. So those are the sort of the two main factors that I would look at.
Got it. All right, let's talk about psychology, and particularly psychology today in a world where U.S. large caps have just smoked everything for a very long time, certainly since we've come out of the great financial crisis in a big way. How do you think about the psychology of investing? How do you think about the psychology of diversifying and bringing in some of these things you were talking about, like commodities and other strategies like that?
So the psychology of investing, I think the overwhelming psychology of investing that I've observed over the last 20, 25 years has been this trap of buying what's just done well. And it's really like performance chasing. We say it on every compliance disclosure, past performance is what? It's no guarantee of future returns. Why do we say it? Because it's true. And yet we all do it. If you look in any asset class, you look at the difference between money weighted and time weighted, which is a way of distinguishing, what the manager has produced versus what the end client has received as a result of the capital allocation. The time weighted return is always higher than the money weighted return in every single Morningstar category, which tells you that investors are terrible timers and they chase what's worked. I think that is the hardest thing for our industry to confront head on. I think is the hardest thing for us as individual investors to confront head on. It's the thing that I worry about. The easiest thing in our industry to sell to people is stuff that's done really well over the last few years. The value that we can have, I think, isn't just in the more honest conversations about, well, what do we think is going to be happening in the next few years? Why might that be different? So I think that's the biggest psychological trap that our industry falls into. You mentioned, US large cap has smoked everything else. I still think, US large cap is going to do reasonably well. Just the law of large numbers. It's hard to see how it can continue what it's done over the last sort of 10 years or so. But the one area, the one asset class that I think is very underrepresented with just the state of the world today at commodities. And part of the reason why they're underrepresented today is because of what I've just talked about. A lot of people piled into commodities in the late 2000s. The financial crisis happened and people lost a lot of money, and they didn't make any money from commodities in the 2010s, and we struggled to have any inflation, and we had all sorts of unorthodox monetary policy, and the central bankers literally trying everything they could to try and push up inflation to their targets of 2%. And we've got quite a different world now. And so I think your average investor needs to have more in commodities. And that's what we've been doing. That's what we've been recommending to clients. I think the state of the world in the 2020s is very, very different from the 2010s. And you need a bit of a different toolkit to tackle that world. And I think the cumulative rate of inflation in the 2020s, it's end of September 2025, it's been about 26 or 27%. So you think about that, the dollar has lost almost a third, if we round it up a bit, but just to keep it in broad generalizations, a third of its purchasing power in a little over half a decade. That's terrible. That sucks.
The magnitude is easy to get a sense of when you go to the grocery store, but from a number standpoint, the magnitude is almost so large, it's hard to wrap your head around it.
Yeah, exactly. And I think we're at a bit of a tipping point with fiat currencies. Fiat currencies haven't been around forever, but it's all we've kind of known in our lifetime. And if you look at the level of debt in sovereign debt today across the world, across the Western world, definitely. And you look at the level of deficit spending across the world, it can't continue. It just doesn't, the math doesn't work. And, I think when you start to get to the natural endpoint, or what do we sort of transition to, I think you see that broadly in fiat currency weakness. And I think we're experiencing that a bit at the moment. And the most obvious way that you see that is what's happening with gold. But I also think equities to a degree as well. People are trying to get their net worth and their assets out of cash, because cash is a devaluing asset over the long run, and especially so at the moment. Sometimes when I look at the commodities allocation, at least the way I look at it in my head is it's almost a physically backed currency. Now, I'm not saying it's a cash replacement, but when I think about what ultimately backs something of net worth, you've got currencies that used to be backed by gold. They're backed by the full faith of governments, whatever that means anymore. And so I kind of like having more of my own net worth that I just want to protect from inflation over the long run, backed by physical things that I know people are going to need, like oil or cotton, or different agricultural products, or precious metals like gold. And I think that's just a really sensible, prudent way of protecting wealth today. And in the 2010s, when we had no inflation, I think we're in a period, and we could be in this period for another 10 years, where we're going to have rolling inflation shocks. And every time we think we've got the inflation cap back in the bag, it starts to come back out again. Because, for many reasons, but, I think a good one is what's happening with central banks at the moment. Central banks, especially here in the US, are under attack. And if you don't have independent central banks, you're almost guaranteeing that you're going to have more inflation than you did do if you did have independent central banks. So I think it's a really, really interesting time. And it just requires like a lot of first principles thinking, rather than just sort of doing what you're doing because that's the way that you were shown to invest.
Yeah, it goes back to what you said, and you and I share clearly this appreciation for this one regulatory disclaimer, which says, past returns are no guarantee of future returns, or past performance no guarantee of future returns. There's always comfort in assuming the future is going to look a lot like the recent past.
Yeah.
And that tends to be true until it isn't, because there is a regime change I mean this in a statistical sense of the term. And I think you're right. How, you have to constantly gauge that trade-off of doing the thing that's comfortable versus doing the thing that may prove out to be wrong, but nonetheless worth doing because it's playing a role in protecting your portfolio, or at least moving your portfolio forward through this concept of investing. And when I talk to, at times, when I talk about finance and investing, fundamentally, the idea is how do you move resources through time and space? And there are more or less efficient ways of doing it. Cash is a wonderfully easy thing to hold through time. But when the space dimension comes in and things like inflation is brought into the equation, it gets very different. So I think what you just said is fundamentally important.
I think people need to, and this is obviously the critical role that you play in your craft, is you want to find out what people are kind of comfortable with or what they need to hold in cash to be comfortable to weather storms. And you want to kind of be right up against that efficient frontier. I lost my job in 2008. And so the way that I invest, I hold way too much cash because I need to.
As well.
I have this deep paranoia that that's going to happen again. So I try and sort of think in my own portfolio terms, what are kind of some cash equivalent ways that I can think about some investing to get me comfortable with actually getting out of real cash. You mentioned something earlier, which made me think, the other thing I struggle with this sort of past performance point is no indicator of future returns. I don't think I believe in mean reversion anymore. And if you'd asked me 15 years ago, was mean reversion investing like a thing? I would say 100%, and it always will be. But I just think mean reversion is now dying. And I think maybe in part because factor investing has become so commoditized as a source of alpha. Mean reversion has just been sort of argued away. And I think the real world that we live in is less of a mean reversion world. It's more of a world of disruption and technological disruption.
Yeah, it feels in a lot of ways. On the one hand, I think it's important for people to think about prices, right? And yet, I agree with you, this presumption that things will revert to quote unquote normal prices does not seem to be a particularly potent guide these days. We're going to close in a second, but one of the things I wanted to kind of reflect on is your point about holding cash and holding perhaps quote unquote too much cash relative to objective measures. I always think about your point because the ride is so uncomfortable. That's the nature of uncertainty, is to go through things that you wish you didn't have to go through. But guess what? It's the real world. Part of it is have enough cash to have comfort. The other thing, when I talk about, the risk assets, let's just call it, the part of the balance sheet that's invested, you said something about just being right against that boundary. And one of the things that I say to people is I want to calibrate risk to the point where we never have the conversation, hey, I didn't sign up for this. Because if you get to the point where there is a state of the world, 3, 5, 10 years down the line, where you look at me and you say, I didn't sign up for this, that's the state of the world in which every piece of rational decision making goes out the window. And because psychology is where the devil resides, when rationality goes out the window, it's like just giddy up. It's sign up for every bad decision you've ever dreamed of making, right?
Yeah, absolutely. Well said.
Well, I know that you're not French. I think we've established that. So I'm going to ask you for some compassion. Talking to a Frenchman today. I grew up in Paris and watched a lot of French TV growing up. And one of the shows I watched was a show by Bernard Pivot. It was a cultural show. People talked about books and things very intellectual, like the French like to do. And at the end of every show, Bernard Pivot would ask his guest the same set of questions. Those questions have been adapted to or were adapted to American TV through the Actors Studio. So are you ready for a quick round of closing questions?
Oh.
What is your favorite word?
What is my favorite word? That is a good question. Creativity.
What is your least favorite word?
No.
Before I ask you the next question, I want to be very clear. You can take it as metaphysically as you need to make it work. What is your favorite drug?
Tea.
What is a sound or a noise you love?
Being inside Selhurst Park when Crystal Palace have just scored.
Love it. What sound or noise do you hate?
Nails on a blackboard.
Who would you like to see on a new banknote?
Right now, I'm going to go back to Oliver Glasner, the manager of Crystal Palace.
It's one hell of a currency note. What profession other than your own would you never, ever want to attempt?
You know, having had 3 young children and just seeing how difficult it can be, I think primary school educators are heroes. And so I don't know if I would have the patience to be a primary school educator, but I'm incredibly grateful for them all.
You know, it's interesting you say that. I tend to find that the profession we would not want to attempt are because we feel like we're not up to the task. And I think you're right. To be a primary school educator is such a hard, challenging task and such an important task. I think it qualifies from that standpoint. If you were reincarnated as a plant or an animal, what would it be?
A cat.
Okay, tell me more.
I just think cats have a pretty cool life. I love dogs as well, but cats kind of like, you have to earn a cat's loyalty. And I don't know, just they're pretty cool creatures.
All right, last question. Are you ready?
Yeah.
If heaven exists, what would you like to hear God say when you arrive at the pearly gates?
Come in.
Well, Kristof Gleich, it was a fantastic conversation. Thanks so much for your time today.
Those were some great questions, Jonathan. Thank you so much.
Thank you.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, treussard.com, for additional information and disclaimers.